In what represents one of the most gloomy short-term predictions of Bitcoin, a significant player in the crypto financial world has claimed that the leading digital asset price performance might not recover until 2025. The prediction made by Huobi CoFounder, due June, paints an unimpressive financial return for crypto investors over the next few years. According to Markets Insider, Huobi CoFounder due June told CNBC on Sunday that Bitcoin prices are often influenced by a technological change in the cryptocurrencies network, called halving. Halving is a key feature of Bitcoin, and refers to a cutting in half of the amount of cryptocurrency that so-called miners receive as a reward for validating transactions. The last halvings occurred in 2016 and 2020, and crypto analysts expect the next one to take place in 2024. A bull market occurred in 2017 and in 2021, and so the next one is likely to happen around a year after the 2024 halving, Du said. The idea is that the halving reduces the supply, boosting the price. If this circle continues, we are now at the early stage of a bear market, Du told CNBC's Arjun Karpal, according to the network's translation. Du co-founded Huobi, a cryptocurrency exchange originally based in China. Yet he added, "It is really hard to predict exactly, because there are so many other factors which can affect the market as well, such as geopolitical issues including war or recent COVID. Following this cycle, it won't be until end of 2024 to beginning of 2025 that we can welcome next bull market on Bitcoin." A bull market is a period when prices consistently go up, whereas a bear market is the opposite. Crypto prices have fallen dramatically since November, when Bitcoin hit a record high of close to $69,000. The cryptocurrency was down 1.8% to $37,683 on Monday morning on the Coinbase exchange. Both cryptos and tech stocks have been hit hard by the Federal Reserve's plans to hike interest rates sharply in 2022, given that both asset classes were boosted by central bank stimulus over the previous 2 years. Some investors are expecting another Bitcoin winter, that is, a period where prices fall and don't recover for a year or more. The last such winter occurred between late 2017 and the middle of 2019, when Bitcoin fell from around $20,000 to below $4,000. According to FX Empire, Bitcoin's price plummeted to new lows during today's trading as the asset's price dropped to as low as $37,200, a level it last touched on February 4. This current price action reflects the current political tensions between Ukraine, Russia, and Canada. The ongoing face-off between Ukraine and Russia has lessened investors' appetite for risk-sensitive digital assets like Bitcoin. Reports have also emerged that authorities in Canada were considering making their financial surveillance regulations permanent. However, despite the threat of this, Canadians have instead embraced Bitcoin as a means of bypassing whatever restrictions the government might be imposing. Bitcoin miners are feeling the heat and the pains rippling downstream to pressure prices. According to Al Arabiya News, the cryptocurrency's spectacular rally in 2021 drew thousands of entrants into mining or producing new coin. As a result, the hash rate, or combined computational power used by Bitcoin miners globally, has roughly quadrupled over the past 6 months to blow past 200 million terahashes per second. A rising hash rate makes it becomes harder for miners to earn coin and cover their costs of hardware, electricity, and staff, so many are more likely to sell, rather than hold, their newly minted cryptocurrency, exerting a bearish force on the market. Running costs are a major factor in miners' decision to hold or sell newly acquired coins. They are the first and most natural sellers in the crypto space, and so definitely impact prices, said Justin D'Anathan, institutional sales director at crypto financial services firm Amber Group. The total value of coins held in miners' wallets has fallen to around $75 billion from $114 billion at the start of November, as their profitability has been squeezed by the rising hash rate as well as falling prices, according to Oslo-based crypto research firm Arcane Research. Miners have been transferring more coins to exchanges than adding to reserves, according to crypto industry analytics firms, a sign of selling or intent to sell. Such flows are adding to pressures facing Bitcoin, whose drift towards the mainstream has seen it caught up in a sell-off in global markets driven by tensions on the Ukraine border and the Federal Reserve's policy tightening. The world's dominant cryptocurrency is trading at about $37,400, which is 40% below its November 10th high of $62,000. Bitcoin mining, in simple terms, is the process by which a network of computers checks and validates a block of transactions that then get added to the blockchain. Miners get rewarded for completing a block. It's an expensive business, though, requiring not just sophisticated and fast rigs costing upwards of $10,000, but also a huge amount of power. And it's getting pricier. The 7-day average of total mining cost per transaction validated has fallen to $176.80 from a record $235.57 hit in May last year, data from blockchain.com shows. As more miners join the network, each individually earns fewer Bitcoin. This is because network difficulty increases in order to slow the issuance of new Bitcoin, said Joe Burnett, analyst at infrastructure and mining firm Blockware Solutions. Waning mining profitability is also hitting the broader market because some institutional investors, who are unable or unwilling to invest directly in cryptocurrencies, instead buy shares of listed miners or ETFs that track miners as an alternative way of gaining access to the young industry. Shares of UD-listed crypto miners Marathon Digital Holdings and Riot Blockchain have plunged 66% and 52% respectively since early November. The Valkyrie Bitcoin Miners ETF is meanwhile trading at a roughly 5% discount to its net asset value since the fund's launch in early February, and the Verity Clean Energy Crypto Mining and Semiconductor ETF has lost 23% since the beginning of the year. Some of the pressures on miners flow from Bitcoin's inherent structure. The decentralized blockchain was created anonymously with a final limit of 21 million coins, of which nearly 19 million has already been minted. It takes around 10 minutes to mine one block, and the reward for miners, who currently get 6.25 Bitcoin per block, is halved about every 4 years. There could be one miner or a million, it doesn't change anything. There's only one block and a set number of Bitcoins issued, said Deanathan at Amber Group.